G'day, Tim. Thanks very much for inviting us along again. Pleasure to be here. So today I've only got 10 minutes, so I'm just going to run through sort of some top down and then bottom up drivers as we see them at the moment. Certainly the economic environment is pretty volatile, and that's a big driver of prices one way or another. So if we flick past the disclaimer and onto the first slide. What I've got here in the main chart is economic surprise. So China is in purple there, and you can see that thus far this calendar year, China has surprised to the upside. There is no doubt the year-on-year growth that this country is achieving is well in excess of where they were in calendar 22. Now, whether or not it's in line with market expectations back in January is probably a subject of debate. You know, some people are basically calling the recovery is mixed versus expectations, but year on year, it is certainly positive. That in turn is driving the seasonal drawdown of metal inventories, and I've picked out the copper inventories on the right-hand side there. You can see that so far in calendar 23, the drawdown in copper inventory is much faster than calendar 22, and that's not surprising because China was in lockdown last year, whereas this year it's ramping up. Now, if we extrapolate those drawdowns in inventory, which is what the chart in the bottom right-hand corner is speaking to, you can see on current projections, we're getting to the bottom of the barrel sometimes towards the end of this calendar year. And as we approach that point, which in turn is going to be influenced by Western world demand and whether or not the US or Europe goes into a recession or for how long that occurs. But at some point, we are going to hit the bottom of the barrel there in terms of inventory. And when that happens, pricing will move to scarcity levels. So, you know, that doesn't mean a sort of a subtle grind up in prices. There's going to be sharp spikes to the upside as people start to realize or behave in a way that, you know, consistent where they know the copper is going to be, you know, $100 more expensive next week than it is this week. So this is why people are interested in this space, and it's why you probably want to get set before those scarcity levels are reached. So that's the top-down view in a nutshell. If we flick over to the next slide and just have a quick look at some of the demand drivers from the bottom up. Year to date, I think the energy transition demand has been mostly felt in the minor metals, so lithium, cobalt, etc. But this is starting to change. So decarbonisation demand for copper was estimated at around about 4% of total copper demand last year. So just to put that number in a bit of context, Escondida, the largest copper mine in the world, that produces around about 5 to 5.5% of global supply. So that 4% coming from green energy, that is starting to be material. And it's been driven by many things. EVs gets written about a lot, but one thing that is really moving quite quickly now is stationary storage. And I've got some charts on that point in front of you at the moment. On the left-hand side there, we've got global stationary storage, which is running at around about 120% growth year on year. That's you know, being driven in no small part by China, where stationary storage growth is growing at closer to sort of 230 to 240% per year. And if those charts with the blue bars aren't quite steep enough for you, keep in mind that is monthly data. If you have a look on the right-hand side there, those bars in red, that's US growth in stationary storage, which on a yearly basis is clearly going exponential. So while the y-axis on those charts is in gigawatt hours, which might mean a lot to some people, the way to think about that is a gigawatt hour of storage will cost you roughly $1 billion at the moment. So that's 17, 18, somewhere, you know, approaching $20 billion per month is being spent on this sector at the moment, and it's growing at over 100% year on year. It's already 6% of global lithium demand in calendar 22, and so is really starting to move the needle for both lithium, but also all the other battery metals and getting up to copper as we move into 2023 and beyond. So, you know, this is a big sector that's really starting to move quite fast, but we're only really getting started in this energy transition. So if we tick over to the next slide, you can see at the moment, the world is spending just over $1 trillion, or about $1.1 trillion on this decarbonisation process year on year. That's split, more broadly between EVs and renewable energy. But we're still only at about 19% renewable penetration in terms of total energy consumption. So that's not electricity, this is everything. We're at about 19.9% renewable share. And it's costing the world about $1 trillion per annum to increase that penetration by 1%. So in rough numbers, you're looking at around about $80 trillion of further expenditure to get to 100% renewables, if that's where the world is going to get to. So, we are at the tip of a very big iceberg that's growing quite quickly, is the point that I want to leave with you from the demand point of view. So if that's demand in a nutshell, if we just skip over to the next slide and just have a brief look at supply. There is, again, focusing on copper, there is, a bit of supply growth coming through in calendar 23. There's roughly about 600,000 tonnes of supply growth forecast. That's been revised down over the last couple of months as operations around the world continue to run into commissioning issues and issues with protests and other, and other sort of dramas on site. But just to put some colour around what this supply response may look like and how long it is going to take to rebalance the market once it does tip into deficit, which it will. I've pulled out some points around the largest contributor to copper supply growth in calendar 23, and that's comes from the Quellaveco mine, owned by Anglo American. It's ramping up in Peru. So this mine was discovered sometime prior to 1992. 92 is when Anglo purchased it. They spent roughly, or just under 20 years there doing further drilling and engineering studies until they got through to 2011 and were convinced that this was a standalone, economically viable proposition. They then spent a further 7 years achieving their social license. So that by social license, I mean everything. So water, power, native title agreements, tax, fiscal, investment regimes, all of the above. Then, so they finally took a FID in 2018 and decided to start building this. 4 years and $5.5 billion later, the first copper started to come out of this mine and will ramp up over the course of calendar 23. And even after all that time and all that money, there was some suggestion that their water license may be at risk. There was some articles came out late last year, but I think that that problem's been swept away. So if you put all that together and then have a look at the chart on the right-hand side, which speaks to copper discoveries over the last 40 or 30 years or so, this contributor to copper growth in calendar 23 has been plucked from the archives of exploration success many years ago. And so you can't go back in time and find these things. So there is a limited number of projects that can be brought forward. But if we have a look at the discoveries on the right-hand side of that chart, specifically the blue bars, not much has been found in recent times, and it takes a very long time to bring these projects into production, and that's not being helped at the moment by government policy. So if we have a look at the next slide, which steps a little bit away from the traditional hard commodities, and this speaks to a problem which commodities of every description are facing at the moment, and that's government attitudes to higher prices, and higher prices are needed to incentivize supply. But if we go around the world and have a look at anything from eggs in the United States to housing in Australia to refining or to gas, right around the world, every time a particular commodity or product soars in price due to that product going into deficit, the politicians are oh so very quick to slap some sort of windfall tax or price cap or some limitation on realizing the profitability from those higher prices. But realizing that profitability is what funds the future supply growth, which in turn will lead to lower prices for those products. So this is a challenge that's part of popular culture and certainly political culture these days, and it only means that this supply response is going to be all the more complicated and likely take longer than in previous cycles. And I suppose, I mean, just to extrapolate where we are at the moment, if we just take the price cap that's been placed on gas here in Australia and have a look at where price caps lead, with this a method of trying to manage prices has been tried before. So if we flick over to the next slide, price caps were tried in Venezuela, I mean, as recently as 2007. And this is a fantastic article in the Financial Times, which just highlights, they tried to put price caps on subsidized food. Turns out that the suppliers refused to sell at those prices because they couldn't make a margin, which is exactly what has happened to the gas industry in Australia, where everybody with a growth project immediately shelved it after that gas cap and sort of reasonable margin provision was announced, and that relies in shortages for those products. The same thing's going to happen to housing, and the same thing's going to happen to every other commodity, exactly as it's happened before. So, we as a group of people and as voters need to realise that higher prices, whilst painful, they ultimately lead to new supply, and we need that new supply. So, this is, I think, is a decision or an attitude around the world now, which is conducive to higher commodity prices. That demand is being driven by just growing population and demand organically, but then a decarbonisation demand stacked on top of it, and we intend to profit from this very handsomely over the years ahead. So, flicking over to the next slide. We've done very well out of this sector since the inception of this fund, which was 3 years ago this month. We've averaged 33% per annum through that period, and certainly the outlook, for the reasons that I've just discussed, remains very bright for investment returns in this sector. And just getting clicking over to the last slide now. I mean, uranium and nuclear is not a big part of our portfolio at the moment, but I like this slide just because it highlights, I think, some of the fallacies and the sort of, I suppose, just conundrum that we've got ourselves into, not having a more open-minded approach to this decarbonisation scenario. What we've got in the main chart here is the energy supply for South Australia. It's got large renewable penetration over there. You can see the solar in yellow, the wind in green, and then the gas in red. And and black is imports from Victoria, which is largely coal. Now, whilst I've highlighted how fast batteries are growing, batteries do have their limitations, and the CSIRO outlines some of this in their sort of renewable storage roadmap, which they released about 2 weeks ago. So that blue box I've drawn there is a battery which has 500 megawatts of capacity and will last for 12 hours. So 500 times 12 equals 6,000. That's 6,000 megawatt hours at roughly $1 million per megawatt hour. That is a $6 billion battery. You can then compare the size of that square to the areas of red and black and guesstimate yourself how many batteries of this size and cost will be needed to remove gas and coal from that grid entirely. Okay, it is a very big number and would require a huge amount of metal to do that, and in all likelihood is not realistic. If we then compare that to the long blue square down the bottom there, I've drawn that to represent what would be required from SMRs to achieve the same effect. And these SMRs are going to the submarines which are going to be built in South Australia. They cost about $500 million each, and these would do 2.5 of these would do that job represented by the blue bar at a much lower cost than the comparable battery technology. So in a nutshell, this is something that should be considered, but still I just think it's highlights I suppose some of the quite odd ideology which is driving battery policy at the moment. But anyway, with that, I'll leave it there and hand over to Tim for Q&A. Thanks very much.
Thanks, Sam. Now, I suppose in this environment, there's a real need for capital, ongoing capital, particularly for these explorers, whether lithium or copper, and kind of capital markets have been turned on their heads recently. What probably got put away a couple of years ago probably can't now. But what are you seeing in regards to the need for companies to raise capital, and how will that play out in this sort of environment?
I suppose it is going to be a challenge, and I think for the fantastic discoveries and new projects, I mean, that capital will be made available. But as I pointed out, those discoveries are few and far between. Also, I think people on my side of the fence are very wary of cost inflation, capex blowouts, and poor execution of these, multi-$100 million type projects. And so we're not really, I mean, I think there is a reluctance to go and lock up capital in a project which takes 2 years to build and possibly, doesn't return a whole lot over that construction period. And then you have the question mark of commissioning at the end. So I think until we see, still higher commodity prices and also, stable fiscal regimes such that we don't think that half the profit of this project is going to be taken off us when it is commissioned. I think that the capital will not be as free flowing as it needs to be to achieve the decarbonisation goals.
And Sam, just finally, in regards to your investment process, do you start with a particular investment thematic like EV, or do you start with a commodity?
We probably start with a commodity, but then that commodity price is driven by demand. So certainly, within the battery metals, EV demand is a big part of that. But then we have stationary storage, which is a growing part of demand for a number of metals, and then we've got the sort of global economic pulse that drives all of the above. So it starts with the commodity, and then we work our way down.
Sam, that's all we have time for. Always great to have you online. Thank you for your presentation.
Absolute pleasure, Tim. Thanks very much.